March 2020 was a rough month for hedge funds, with a dismal industry performance of negative 8.12% returns across thousands of funds of varying sizes and strategies. Yet, not everyone was caught wrong-footed in the market turmoil. Mark Spitznagel, protege of Nassim Taleb, hedge fund manager and part-time gentleman farmer / goat cheese producer, booked a staggering return of 3,612% in the month of March, amid one of the most severe crashes in market history. The question is, how did he do it? An investor's strategy is like a magician's tricks or a chef's prized recipes, a proprietary secret to be protected at all costs. Spitznagel even admonishes against trying to emulate his strategy, stating, "This is a dangerous place for amateurs and professionals alike to play, so I'm doing people a favor too when I'm not telling them what we do." I find this staunch warning to be somewhat puzzling. After all, he devotes 2 full chapters in his book, The Dao of Capital, to the practical application of his theory of roundabout investing. And while the strategies outlined therein are admittedly simplifications, the data indicates someone following those principles would have outperformed the market over the past 100 years. Past performance is not indicative of future success, however, and Mark Spitznagel is a truly gifted individual who by the age of 20 had already made over $480,000, writing a program for Hewlett-Packard in the early 1990s. He also has a cadre of other mathematically inclined PhDs at his disposal, so undoubtedly the strategies discussed in this video only scratch the surface when it comes to the level of sophistication seen at his fund. I am also not an investment advisor, and these videos are for educational purposes only. With that out of the way, let's go over the 2 core ideas behind Spitznagel's investment strategy. Number 1, tail hedging, and number 2, value investing in businesses with a knack for the value-creating, efficient allocation of resources. Businesses he refers to as Siegfrieds, after the dragon slayer in Richard Wagner's Ring Cycle. The first strategy is closely related to Tobin's equity Q, which is the ratio between an asset's market value and its replacement value. Take the McDonald's Corporation, for example. It is a publicly traded company with a market capitalization of around $135 billion. We can plug this number into the numerator. Now, they hold a number of assets: land and improvements, buildings and improvements, machinery, furniture, equipment, goodwill, and other intangible assets, like the iconic Golden Arches logo, and the intellectual property on Ronald McDonald, and a slew of other characters, etc. The sum of these is the replacement value associated with McDonald's, the cost of essentially trying to replicate the company's business operations, and this number goes into the denominator. The Federal Reserve aggregates this data for all non-financial corporate businesses, allowing us to calculate Tobin's equity Q ratio for the US stock market as a whole. Broadly speaking, an excursion into deep fractional territory, like in Q1 of 2009, when Tobin's equity Q ratio bottomed out at 0.66, signals corporate assets are severely undervalued and likely primed for a nice leg up. Similarly, a soaring ratio, like the all-time high of 2.14, reached in Q1 of the year 2000, portends a momentous market correction. The data in Spitznagel's book is more complete than the time series found on the Federal Reserve Bank of St. Louis's website, and goes back to 1901. He also scales the chart by applying a running geometric average to the data series, revealing the sombering nature of the boom and bust cycle. After the first cycle, from 1901 to around 1925, a simple strategy of buying near the lows and selling and going into 1-month treasuries near the top would have consistently beaten the market and outperformed the overwhelming majority of hedge funds. Spitznagel further refines this strategy through the introduction of out-of-the-money put options. When Tobin's equity Q ratio shows a reading in the third and fourth quartiles, a simple tail hedging strategy with a 0.5% monthly allocation to 2-month 30% out-of-the-money puts on the S&P outperforms the index and allows the holder to remain invested in quality stocks on the long side throughout periods of market turbulence. Now, admittedly, while one could argue the nature of the business cycle was already apparent in the 1920s, the 1940s, and the 1960s, it would have taken a great deal of foresight and courage to implement such a strategy. Plus, we have been seeing higher peaks and higher valleys, to such an extent that someone hoping for a retrace back to the 1980 lows would have missed both the post-dot-com bubble rally and the stock market boom that started on March 10, 2009. That notwithstanding, I believe there is both deductive and empirical validity to this simple strategy, because of the numerous and not at all infrequent opportunities for extreme returns in recent years. The August 24, 2015 flash crash, the early 2016 downturn, the June 2016 referendum, the 2016 elections, the day the VIX doubled in February 2018, the Christmas crash of 2018, and the recent 2020 stock market crash. Unsurprisingly, as of March 26, 2018, Spitznagel's Universa hedge fund had delivered a compound annual growth rate of 12.3% between March 2008 and February 2018. After the March 2020 payday, Universa's flagship Black Swan fund has produced a mean annual return on invested capital of 76%. As you can see, tail hedging has been a rewarding strategy in recent years, and is likely to remain so for as long as equity prices continue trading at levels greatly detached from the historical average. This is the tail hedging aspect, but ideally, one would apply this protective strategy to a portfolio consisting of names capable of delivering excess returns over the S&P 500. Spitznagel hones in on productive companies with extreme returns of over 100% on invested capital. This makes intuitive sense, as you'd probably want to stay away from capital-intensive businesses with low profit margins, like in, say, the automotive sector. Ideally, you'd want to find a company capable of delivering the most profit with the least amount of capital outlay. Moreover, a high return on capital virtually guarantees companies will want to reinvest in the business, and it is this compounding over the years that leads to explosive exponential growth later on. But return on invested capital alone isn't enough. Any individual title worthy of inclusion in our portfolio should also have a low Faustmann ratio. Originally developed in the field of forestry studies, the Faustmann ratio compares the expected value of developing a given parcel of land, the land expectation value or LEV, to the land replacement value or LRV. The price of a stock, and by extension its market cap, is determined by discounting the sum of future cash flows, its expected value. So the Faustmann ratio is just as applicable to forestry rotation as to the capital markets. If you estimate a company will generate $500,000 in profits over the next 5 years, and another $1 million over the rest of its active lifespan, how much should you be willing to invest in the present? This calculus is the stock market in a nutshell. find out what something is worth and try to pay less than fair market value. Ideally, we want a growth stock that is so severely undervalued that the market thinks it's worth less than the cost to replace its machinery, intellectual property, etc. So what we're really looking for is a Faustmann ratio at or below 1. As applied to the valuation of companies, the Faustmann ratio is equal to market capitalization of equity divided by net worth. This calculation is somewhat tedious, but can be performed through diligent digging in the balance sheet. This is to be expected because, after all, the path of least resistance is hardly ever profitable. Spitznagel's strategy isn't for everyone, as you can look rather foolish paying insurance while waiting for a market crash that may never come. Most people would prefer a steadier, less volatile ride, but I believe Mark Spitznagel's results speak for themselves and make Universa's hedging strategy worth looking into.